Hello, friends and family. Welcome back to my channel. So, guess what? We are on day 3 of the financial fast. So, on the last video that I made, um, just to let you guys know that I am doing a financial fast, and I have done this before, and it was very effective, and I just wanted to do it again, but I want to do it with my friends and my family. That way I can be a blessing and just share what I know and just bring financial peace to someone else. So it's just my whole objective. And it's just good to just budget and to understand finances a little bit better. So hopefully you guys did watch my last video and you got all the supplies that I have recommended for the fast as well as for the budget. And hopefully you have already started your journey. I'm hoping you have started your journey with me as we go through this financial 21-day fast. So, okay, so day 3. So today, what I want to talk about, something that's pretty critical and it's important. So before we can even begin a budget, we need to look at our debt to income ratio. We need to look at how much is coming in and how much is going out, right? Because how can we effectively budget if we don't even know how much money we have to budget with? So one of the things that I'm going to focus on today is debt to income ratio. So I got my handy dandy whiteboard here, and what I wanted to do was just give you guys an example of how to do a debt to income ratio with your income, so that way that you can understand it a little bit better. And I like the whiteboard because, again, I like to be visual. So, okay. So, debt to income ratio. So basically what you do is you take your debt, and debt basically is anything that you owe money, such as credit card, car loan, mortgage. So let's say in this example, you have about $1,500 worth of debt, okay? So this is your debt. Okay. Now you want to divide that by, let's say your income, your gross income is $2,000, okay? Sorry, my handwriting's a little bad. So you divide, so this is your income. Oh, that's horrible. My handwriting is horrible. Hold on. Hopefully you guys can see this good. Okay, so that's income. So $1,500 divided by $2,000 equals 0.75. Okay. So basically what this means is that 75% of your income is going towards your debt. So I have this pie chart over here, which is 100% of your income, and it's broken down into 4 quadrants, okay? So I'm a visual learner, so I wanted you guys to see this visually and what it looks like. So 75% would be this much of your income. So this is your income, right? 75%. And so that is going towards your debt, okay? So that means you only have 25% left to budget for eating out, shopping, and other miscellaneous things. There's only 25% left, which is not a lot. This number is actually pretty high. You really want your debt to income ratio to be low. And one way to lower that, of course, is to increase your income or to decrease your monthly amount that you're paying. So basically decreasing your debt. That's how you get this number low. Now, the reason why this is so critical, you guys, is that a lot of your creditors, or even when you go to buy a house or apply for a personal loan, they use this ratio to determine your credit worthiness. And basically they use this to make decisions about you. So if you can understand how this works, it will work in your favor. And I'm going to do another video on credit, but this is so crucial, you guys, to understand and know how this works. Okay, so 1, we talk about debt to income ratio. Got to know what's coming in, what's going out. I want you guys to take your debt. I want you going to list it out, and then you're going to divide it by your income. Now, hopefully you all got the manila folder that I had recommended. We're going to just focus on the first two columns, which is revolving credit and your installation loans. A revolving credit is any credit card. What that means, revolving credit is just where a creditor will give you a credit limit, okay? And you make purchases, and then you pay that balance off at the end of the month, end of 30 days, basically. If you don't pay it off, they're going to charge you an interest rate, right? That's what revolving credit is. Installation loans is basically like your mortgage, where it's a fixed amount that's due, and you know the amount every month, and there's a time frame attached to it, such as a 15-year or 30-year loan, such as on a mortgage. So those are the two types of debt. So what I want you to do is list all of your revolving credit here. And what I did is I listed the name of the credit card, the interest rate, when it's due, and my credit limit. That way I can know. Basically, this is just a snapshot of everything that you owe. That way you can look at it visually and see what you owe. The installation loans, you do the same thing. You want to list the name, the interest rate, how much you owe, and the balance or the amount of the loan that you took out. Okay? Very, very important. So that's your homework. That's your assignment for today. If you haven't done it already, I want you to list out all the revolving and all your installation loans. Okay? I need you to understand how it works, because it's going to be very important later on when we start really digging deeper into our finances and how all that works. So, okay, hopefully you guys are reading your journal. Not reading your journal, we're writing in your journal. Duh. Hopefully you're writing in your journal, and you're just staying faithful to this fast, because I know it's hard and it's challenging. There's a lot of work, but you know you can do it. I did it. I know you can do it. And we're going to make this real simple, and we're not going to quit, right? So, okay. Well, thank you guys for jumping on. Don't forget to like and subscribe. And remember, be blessed and be a blessing. Love you guys.